Hello and welcome to the HFA webinar, Managing Volatility Amid Heightened Inflation. I'm Mitch Hackles, the Hedge Fund Association President. I want to thank you for taking the time to be with us today. The HFA, just quickly, is a global nonprofit trade organization. We have chapters in 16 countries, and we serve the entire alternative investment industry. Before we begin with the program, I want to thank our sponsor, MIAX Exchange Group, and HFA's annual thought leader sponsors, Trinet, UMB Fund Services, and Citron Cooperman. For our attendees, after our panel discussion, we will open it up to your audience questions. In the GoToWebinar sidebar that you have, you'll see a box for chat or questions. You can type those in there, and the speakers and I will be monitoring them. Should we have time at the end, we'll do our best to address as many of them as we can. Now let's meet our panelists. Ben Eifert is the managing partner and CIO of QVR Advisors. Mandy Zhu is managing director and head of equity derivatives strategy at Credit Suisse. Chris Tidial is the co-chief investment officer at the Ambrose Group. Tom Jark is the vice president of proprietary product development at MIAX. To all of the panelists, the Hedge Fund Association truly appreciates your time today. Now let's get started. Ben, you are my first victim. So I want to go, and so you guys know, obviously, as we've had a couple of discussions, we're going to have this as interactive as possible for our attendees. Don't be shy. Feel free to comment on each other's questions as well. So Ben, what have been prevalent strategy approaches by institutional investors to manage portfolio volatility, and have they worked? Could you explain why or why not?
Sure, Mitch, and thanks for having me, man. So I think historically, if you look back over long periods of time, right, many asset owners have relied on fixed income to dampen losses and risk-off periods and dampen volatility of portfolios. The last few years, I think a lot of asset owners looked at where yields were and looked at what they thought the landscape in the world looked like for the next 5 or 10 years, if rates were going to rise, if inflation was going to rise, right? And they made the decision to cut their fixed income allocations and look for other ways to manage portfolio volatility, right? Part of that was investing in diversifying strategies with some of that money that they took off of the table. Depending on their outlook and risk tolerance, I think some people put that money into private equity, thinking of that as a volatility dampener because you don't have to mark the portfolio. I think you know, we can talk about that later and how that's going right now. I think it's a little bit of a different choice. But for example, for us, many of the asset owners who invested with us in our absolute return strategy and volatility over the last few years were explicitly looking to replace some of their fixed income exposure and to find other places to put that capital, not necessarily as a directly comparable substitute to fixed income, but just as a diversifying strategy that could perform even in a down equity market, as opposed to just doubling down on equities. I think other asset owners looked explicitly for long volatility or tail risk protection, right, to be able to maintain that large equity exposure, but to feel comfortable that a major risk-off event they'd survive okay. And so we manage customized overlays designed to provide a major source of strength and cash liquidity in a severe market downturn. So I think those are some of the themes that certainly we've seen over the last couple of years.
Great, thank you very much. Mandy, turning to you, we've all seen transitory versus persistent as it relates to inflation and inflation risk. How are various asset classes pricing inflation risk? Can you comment on that? And does anything stand out to you?
Yeah, sure. First of all, thanks for having me on. I figure since the title of this webinar is Managing Volatility Amidst Heightened Inflation, it might be important to talk a little bit more about the inflation backdrop and what we're seeing right now. So a few things that to me is very notable, right? So obviously the Fed came under a lot of scrutiny and last year, if we're calling inflation transitory, since then they've clearly pivoted, and we're going to see today, I expect them to hike 75 basis points. They've clearly pivoted to thinking inflation is going to be more sticky, it's going to be around for longer. What's interesting to me is just as the Fed is making this pivot, markets are making a pivot the other way in terms of pricing growth to be the bigger risk. So what am I talking about? If you look in the bond market right now, what's really notable to me is just actually how well behaved inflation expectations have been this entire time. If you look at like forward inflation expectations and what market expects long run inflation to average, we're still trading at, below historical average levels. Further if you look elsewhere in the bond market, traders are already pricing in Fed rate cuts starting, next year, over 35 basis point of cuts already priced in. That's a bond market that thinks, we're going to recession. Now that, inflation is here to stay. And actually the best way of looking at it for those, who don't track inflation break-evens or Eurodollar curves, just look at the 10-year yield. I say this all the time. A bond market where the 10-year yield is trading with a 3 handle is not a bond market that is overwhelmingly concerned with inflation, right? It's not a bond market that thinks inflation is persistent. So what does that mean is, I do think this means that there's further downside risk to markets, to risk assets in particular, because of the disconnect. The Fed is, in my view, too complacent on the downside risks to growth, too complacent on recession risk, and almost single-mindedly focused on inflation. And what that has done recently is just inject incredible volatility into the bond market, into the credit market, into the the macro like FX markets. The only market where we're not seeing incredible volatility is the equity market in terms of implied vol, and we can talk about a little bit later why that is the case, why equity vol is underperforming. But just to kind of put the moves in perspective, what we're seeing right now, levels of interest rate volatility, it's basically at levels outside of the global financial crisis we've never seen before, right? It's higher today than during any point during COVID 2020. It's higher today than at any point during the tech bubble and in the early 2000s recession, and it's higher today than during, obviously the late 90s, the Asian financial crisis. So what we're seeing is higher rates vol, higher credit vol, higher macro volatility, but not a lot of equity vol. And we'll talk about why that is the case later.
Great, thank you very much for that. Chris, turning to you, how do you protect a portfolio from an exogenous event?
Yeah, so when I left the trading desk at BMO to start Amidst, I think one of the most eye-opening things that I noticed was that a lot of investors struggle with this really simple concept, even though throughout history, this concept has worked time and time again. And it's really taking a small piece of an overall holistic portfolio and allocating it to something like tail risk, right? And it's important to have an understanding as to what are the points in a portfolio that you're trying to cover, right? So some people may say, hey, if I'm trying to protect against a crash, I may be interested in some sort of tactical trend allocation. I may be interested in some sort of long vol allocation. I may be interested in some sort of tail risk allocation. But the idea that you can take a small piece of a portfolio, let's say 5% worth of a portfolio, and put it aside, and if markets are fine and markets are going up, maybe you lose 7-10% type of a bleed on that small 5%. But if equity markets are crashing, the asymmetry of this will make it so that on that 5%, you could potentially make 300%, 400%. And that type of return profile really offsets the losses that come from the remaining 95% of your portfolio, right? And if you think about it conceptually, it's amazing to me that it's so much of a struggle, because people take these bets all the time, right? The government actually mandates you to take these type of bets when you think about it, because you can't drive a car without insurance on the car, right? So you pay a small premium every single month to make sure that the car is protected. And when we're out there talking with family offices and RIAs, one of the things that we kind of relate to them is that, look, if you have a $250,000 car, you're going to insure it. If you have a $20 million home, of course, you're going to insure it. But when people think about portfolio construction, right, they'll have a $400 million family office portfolio, and you say, hey, what happens if the equity market drops 20-30% over the next 2 to 3 weeks? And what they'll say is that, well, bonds and gold will be the protection, right? So traditional hedges. Whereas equity to bond correlations have been extremely poor, specifically over the last 3 to 4 years, right? That 60-40 blend is one of the worst performing vanilla blends like right now. And then if you look in a wider time frame, that blend that's paired with equity, some sort of equity beta with tails has actually been a extremely good performing strategy over the course of a decade or so. Great. So I think one of the things that we also try to stress is that when you're thinking about tail risk, it's not necessarily like a strategy per se. It's a part of how markets function, right? Markets will go up a whole lot further than people anticipate. Markets will go down a whole lot further than people anticipate. So you should always have some sort of constant protection that will be there that will cover some sort of overnight crash, an event where maybe your tactical trend allocation or maybe some sort of tactical equity allocation can't cover. And I think it's really important for people to understand that it's not to say that tactical trend is better than long volatility or long volatility is better than tactical trend. But I think when you're creating a holistic portfolio, you have to think about merging these pieces and making the correct weightings as to what can optimize the portfolio.
Thank you very much, Chris.
I'll
Tom,
just
turning
jump
to
in
you.
actually on that topic, because I noticed you talked about the 60-40 portfolio. That's definitely something that we've gotten a lot of questions around the correlation breaking down between stocks and bonds. And I will say that again ties back to the question of whether inflation is here to stay, because the periods historically where we've seen persistent breakdown in that correlation was obviously the 70s and the 80s when we had persistent inflation, right? So your view going forward has to be, are we in a different inflationary regime? If we are, then yes, I would say you need to look at more explicit correlation hedges, or look at fixed income replacement, or look at other strategies, because your bonds are no longer going to diversify your equity risk. Now my view is that inflation is not going to be persistent. I do think we're in a very different environment now than say the 70s and the 80s, particularly with wages and the labor market, and we're not going to get that famous wage price spiral that we saw back then. So we're in an environment right now where we're seeing elevated inflation, but as I mentioned, the bond market's not expecting it to persist. I don't expect it to persist, and I think the Fed's going to drive us into a recession before we ever see persistent inflation. So, but that's something that definitely in terms of what investors are talking about, focusing on, this is a big topic, because as it relates to portfolio construction, the diversification benefits of holding bonds in your portfolio, and what you should be looking at. And one thing that has been really popular recently is, particularly with regard to inflation and portfolio, is adding commodity exposure, right? So if you do think commodity inflation is here to stay, and you're concerned about it, one way we've seen asset owners hedge that risk is by going long commodities. So yeah, that's
just a little bit pushback on that. Not really too much pushback on that, Manny, but I think a big point to emphasize, if you remove the inflation theme and you think about markets under stress over the last 3 to 4 years, you've seen during those risk off moments, like specifically during March of 2020, right, where inflation wasn't really the main focus, but that correlation break was still very persistent. And I think a lot of people who had that vanilla blend got hurt, especially some that were in high yield credit. So definitely in agreement with what you're saying, but I think going forward from a holistic standpoint, people should think about these type of risks independent, because those traditional relationships are just consistently breaking down more and more and more as we go forward.
Yeah, no, that's fair. Like I think March 2020, we definitely had a 1 week period for sure where equities, bonds sold off massively together, and that correlation did flip. So yeah. Great.
Chris, I just want to touch on you mentioned something about on the hedges and things like that. Was that when you're hedging those those shock events and things like that, that hedging instrument is something that needs to be liquid enough that in that time of chaos and in the conundrum you're in, you want to be able to monetize that hedging vehicle. I've seen it a lot where people try to get too creative and create these wacky type strategies and structures that when they go to unwind them during times of stress, they don't have that that liquidity that they need because their structure is too complex. So my one just comment I wanted to make was that when your overall portfolio is pretty complicated, that's great, but your hedge for that shock event needs to be something in a much more liquid fashion.
Yeah, I would completely agree with that. I think we'll get a lot of questions from investors about who are getting pitched exotic structures, usually from banks, where the pitch is, hey, look, here's this sort of, you can isolate this small part of the probability space where equities are down and rates are up and gold is doing this and it's really cheap. And it's like, okay, but that's a super exotic instrument that you have no ability to price. You don't know what the right value is. What's going to happen is the market's going to move. You might have sold some hidden optionality in that product that didn't turn out the way that you thought it would go. Plus, are you actually going to be able to get a good bid for that structure to unwind it in the middle of March 2020? Probably not. I think there's a huge value in hedges being things that there's going to be force demand for, and you're going to have liquidity to sell or to rehedge in a simple way in a crisis.
Mitch, did we lose you?
We might have lost Mitch, but I think we know what we're talking about, so we can just keep jamming.
So I just want to get, I just want to get in one thing just on the, as we're talking about volatility, just, one thing I wanted to bring up was, Mitch has the slide access, but we'll get it in a minute. Just, volatility indexes that people monitor. So on the equity side, typically we're looking at, the VIX index is a big, been the all-time go-to favorite. And I just wanted to, I'm going to talk more in reference to things today using the Spikes Volatility Index, which is relatively new to the marketplace over the last, several years. But again, it's a measure of that 30-day expected volatility. I won't get deep in the weeds right now, but I just wanted to, let the audience know that there is a different volatility index that I typically follow now. It uses a similar variance swap methodology as the VIX. VIX is priced off SPX options, whereas the Spikes Index is priced on SPY options. So both, both relating to that S&P 500 stocks, the top 500 stocks. So other than some general nuances between the you'll see some price nuances here and there, but generally they're very, very correlated, especially on the futures side if you're trading on the futures. And I just, Mitch, there's another slide I wanted to reference if you can get it up. Otherwise, we'll go on to another question.
I apologize. Something happened and the whole internet went down. Can you hear me?
I can hear you, Mitch. One of the things I wanted to talk about was just, the vol relative to inflation and relative to rates. But when you get the slide up, we'll come back to it. No problem.
Yeah, we can come back to slides. Totally. Yeah. Mandy, why don't you tell us a little bit about how equity vols behave during past Fed hiking cycles and how things are going to be different this time.
Great, thanks, Ben. Sure, I'd be happy to. So I would say, I do think this time is going to be different, but in terms of how equity vol has behaved in past cycles, it might, I think, surprise a lot of people, because certainly there is this conventional narrative that as the Fed tightens and hikes rates, equity vol should be higher. Now, empirically, over the past 25 years, the opposite has actually been true. Equity vol has, in general, trended lower during a rate hiking cycle compared to the period before. And I think it matters to kind of think about the fundamental backdrop. Historically, and when I say the past 25 years, only starting in 1994, did the Fed start announcing changes to the policy rate. So prior to that, they actually didn't make an announcement. So it's hard to gauge an immediate impact on volatility. So since 1994, when they started announcing changes in Fed policy, what we've seen is the average of equity volatility tends to be lower during rate hiking cycles than before. And the reason is because, over the past 25 years, the Fed has only really hiked when economic growth is good, is robust, right? When the economy is on the verge of overheating. And again, that's an environment that, corporate earnings can continue to grow. And that's exactly what, what's happened in through the last 4 cycles. Markets have actually ended up higher and vol lower as a result. But this time, I think it is going to be different. It has been different, obviously, the past couple months. It's because of inflation. And for the first time in a very long time, the Fed is extremely worried about inflation. I think, they're panicking when they don't need to be. So, I do think they need to be tightening, but, I think the way they're doing it right now, and kind of introducing even additional volatility into the market. But I do think that that's the big difference is between now versus, previous cycles, is just the more elevated inflation environment. And as a result, more volatility into the market.
Yeah, for sure. Mr. Hartford, I'm going to cut you off on this one. No, but I think, we get this question a lot recently, because there's this view that vol has underperformed, which, relatively speaking, when you're thinking about, hedges, we could definitely agree with. But it's also important to understand that this decline took 6 months to happen, right? We're in June now. And really to get that spike in vol, you need that type of exogenous shock. And I think during November and December, you realize that spot to vol relationship performed really well, right? So like immediately markets went down a little bit. It was that Black Friday week, and vol started to outperform, from across the board. But then what you started seeing was that, okay, January came around, February came around, March, April, May, and a lot of people started abandoning the ship on vol. And a lot of new hedges that were coming in, to aid Mandy's point, were inflation based. So a lot of people were moving flows into the CTA space. A lot of these new hedges that came on were more so Delta One based. And I think that's really where a lot of people's headspace is right now is, okay, we want to gauge inflation. So CTA, commodity trend following, things of that sort, seem like a better bet. That Delta One type of protection seems like a better bet. And in a way, I think this has actually opened the door for vol to outperform if you do get that shock event, because everybody's kind of pushed vol to the side, equity vol to the side, and it's like, all right, this is not working. And if you take a very naive way of looking at vol, you look at the VVIX that just measures VIX calls, right? In a primitive way, it still shows you that reach for upside convexity has not been there in the equity space. And I think it's just because that rotation into the Delta One hedges have been there. But it just opens up the question that, well, if you slide 20% lower, I think that reach for convexity will be there, and that spot to vol relationship will start to outperform.
Great.
Yeah,
Tom,
totally.
just turning back to Tom for a second, I don't think you had a chance to talk a little bit about spikes, or did I miss that when I went down?
I covered it. It's yeah. I just wanted to point out that I was going to reference spikes in my conversations today, rather than VIX. And I just wanted, this chart kind of points out the some of the how correlated the two products are to one another. But that's fine, Mitch. Thank you.
Okay, great.
But Ben, you had the spot vol correlation.
Yeah, and maybe real quick, just to I think build on Mandy and Chris's points. So when we structure tail risk hedges for big asset owners, we think a lot about different types of diversification and robustness of those portfolios. And one of the really important types of robustness is robustness to path, right? Because generally an asset owner owns a bunch of equities, and if equities go down 30% in a week or in 6 months, it's kind of the same to them for the most part. They're equally unhappy about that. But obviously different kind of hedges are going to work very differently in those type of environments. And that's inevitable. But what you can try to do is structure a variety of exposures that at least have a reasonable chance of performing pretty well across those range of different paths that you might take in an equity market drawdown, right? Now, I think that you do see folks that focus very heavily on very short-term type hedges. And I think, looking back at the last 10 or 15 years, you kind of understand where that comes from, because we had a lot of sharp market drawdowns followed by really sharp quick recoveries, and those kind of near-term convex hedges worked really well. But if you look back through history to things like the tech bust, like that would have been, that was a very painful process for investors, losing 50% over like 18 months, 2 years. Okay, that's a very hard path to hedge. But a lot of what we do tries to leverage longer term options and holding not a lot of local convexity, but a lot of deep tail convexity that will realize in a 6-month or 1 year drawdown, because you're letting portfolios run and build short equity market exposure to the downside and not have a lot of basis risk to what's happening in the market, not be overloaded just to upside volatility or to the particular path that a market crash with a big ball spike, you know, takes. And again, it's nothing's perfect, but putting a broad-based effort in across different types of positions that will perform in different market environments and different sell-off paths, I think really can help address that, you know, concern about, well, you know, look, what if we have a long grindy sell-off? You have exposures in the portfolio that'll perform in a long grindy sell-off.
And I think that's so important, right? It goes back right to the beginning of creating a holistic portfolio where people, you know, you have to lay it out to them. And in our hedge fund, this is exactly what we do. We say, look, what are you trying to cover? Because this is the area that we believe should be focused on and when covering, right? But if you're thinking about some sort of other type of coverage, we may not be a fit for you. And I think that's really what it boils down to, is the investor's understanding to look at a portfolio from a holistic standpoint and say, what are the scenarios that I believe are going to occur, and how can I protect against that? Because you kind of have to take a stand, you know, in some way, shape, or form, right? You have to put your bet down and say, all right, I believe that there may be a 2-year decline in equities, or I actually think that there's going to be a 3-month crash in equities, or, you know, I may think that there's going to be a 2-week crash. But it's important to have the understanding of what those paths look like when you're constructing a portfolio.
Actually, that's a great point. I just want to go back to the underperformance of equity vol and the spot vol beta relationship, because sitting on an equity vol desk, I would say that is by far the #1 incoming question from clients over the past 6 months. Is why is VIX or equity vol or spikes, why isn't it higher in this environment? And I talked about how if you look in the cross asset space, right, every other asset class volatilities is at multi-year highs. Basically outside of global financial crisis, the highest ever on record. You look at equity vol trading 20, 30, mid 30 range, that's really nothing that unusual. That's really not that's not that elevated by the standards of equity volatility. So I would say probably a few main drivers. The first I want to just talk about is positioning, and this has been key, right? So what we've seen is, since the beginning of the year, very significant de-risking on the part of equity investors, particularly U.S. hedge funds. I won't belabor the point. You've all seen the headlines, massive liquidations, out there, but basically gross net exposure for hedge funds at multi-year lows. What does that mean? That means, if you take down your exposure, go to cash, you don't need to buy protection, right? You don't need to spend premium to buy puts. And that's why, I would say we've definitely noticed on our desk a significant drop off in terms of demand for downside protection. And what that has caused is not just equity volatility being muted, but all these other parameters in the equity vol surface also becoming dislocated, right? So if you look at equity skew, that's also at multi-year lows. And if you break it down in terms of what is causing it, skew is low, not because people are out there buying upside calls, playing for a rebound. Skew is low because there's no demand for downside protection. So put skew is currently at or near 2-year lows across every tenor in the S&P, which is very unusual given that we're in a bear market. So that's #1, just demand, outright demand. And on the surface, it might look like people are complacent, not pricing a lot of volatility, but actually, if you couple that with positioning data, it suggests that people have already largely de-risked. And I can say, from just all the meetings I've had, and I've been on a marketing, roadshow for the past 3-4 weeks, in Europe, US, Canada, South America, I've yet to meet a bullish investor in this environment. In the 50+ meetings that we've had, every single client that we met with is bearish, right? And I think that's why it's going to take a lot more to get that shock to the market to get volatility to perform. Now you add on to top of that, we have no demand for downside protection, and then in terms of the most constant supply trade that we see, the most consistent trade that we see on the desk is just people out there selling options for yield. The yield harvesting, that desire for yield has not gone down despite the move higher in rates. That demand for yield, I think we would need 10-year to be a lot higher before that appetite for yield really starts to shrink. So constant supply of vol, into the market, really no demand. I think that's why, you know, equity volatility is where it is. In terms of what will it get, what will it take to get it to really move? You know, you would obviously need to see some changes in the supply-demand dynamic. And I think what you really need to see is, like Chris has mentioned, something exogenous, right? Like the unknown, the unexpected, because what we've gotten this year is clearly a very large market drawdown, but really a drawdown on the back of very much expected or anticipated risks, right? Higher rates, hawkish Fed, higher inflation. We've been talking about this for over a year now. It's really nothing new. It's not shocking. So you do need something to shock the markets. And that's why you want to talk about, like, you know, equity vol outperforming. The two notable periods in the past year when we've seen that, one was November last year, like Chris mentioned, right? What happened then? Omicron, right? Omicron came, that was unexpected, it hit markets, equity vol outperformed. And the second was in March of this year, the Russia-Ukraine crisis. When that first hit, and particularly when the sanctions first hit, we did get a brief period where equity volatility outperformed. You got a bigger move in equity vol than you did in spot. So I think going forward, you know, for it to be more sustained, we're going to need to see a bigger exogenous shock, because positioning has become so defensive. I think it's, you know, it's going to take a lot to really kind of shift us into a new regime.
Thank you, Mandy.
If
Go
I
ahead,
could,
Tom.
just on the positioning comment, I just want to make just a couple references. Just, you know, from my former role in you know, working on a trading desk at a big bank. Yes, the positioning is very important, and the dynamics of the portfolio that most, you know, trading desks are trying to manage to causes a lot of rehedging. And I just wanted to reference, you know, something I saw on LinkedIn the other day. Someone put in, you know, the big reference to this big put spread collar on in the SPX. And it's very important to know that, like, as the market has sold off towards the long strike of the dealer community, they've had to, you know, to sell and you know, which puts pressure on the volatility in general. So they've had to sell to keep their portfolios within their, you know, usual risk limits or risk parameters, you know, just based on the general rehedging. So to your point, yeah, it's very important to know, you know, the positioning out there, the structured products world, and just some of the bigger key positions that the market's hedging against in the volatility community.
Thank you very much. Chris, did you have anything you wanted to add?
I feel like we're on a lot of points. You know, I got a ton to add, but it depends. You know, which angle are we going here? I mean, I think what Mandy said was very, very true. You know, from a local vol standpoint, we're looking at things in like 1 to 3 month vol, way out in the tails on the equity side, and we're looking at this and we're like, you know, the repricing on this it's non-existent. I mean, you're seeing things out there in the equity space that are not moving at all, and relative to what at the money vols and spot and the broad market is doing, it just seems like really, really good value from a vol trader standpoint. You know, I feel like every single day I'm waking up and there's some other headline, you know, this crypto fund's going under, this, you know, this is selling off, nat gas is moving like this. It's literally like, I feel like there's so much variability flying around, and I'm just looking at all these things and I'm like, huh, equity vol is still not moving. Okay. I think the positioning thing is just so crucial. One of the things that I look back on was in November and December, we had a couple of investors come on board who are actually doctors and lawyers, and I make this joke that, you know, the doctors and lawyers were saying equity markets are going to go down because of inflation, and I was actually on the other side of that, because I was just like, markets don't really work like that. You know, when the doctors and the lawyers are saying markets are going to go down, it's probably not true. So I was wrong there, right? And I think it aids into why equity vol has underperformed as well, because it was very well telegraphed across the street, right? Positioning had a chance to rotate. There was no type of offsides positioning or shell shock event. So I think it's one of those markets where you will see people end up being complacent, because you know, as I kind of alluded to at the beginning, is this tail risk is not a strategy. It's just a part of how markets function. And everybody is like, oh yeah, S&P will go down to 3,500 and that's the Fed put, you know, or, you know, 3,000, that's the Fed put, and it just never works that way. So it's a lot of moving pieces for sure right now.
Great. Ben, do you have anything you wanted to comment on or add to that?
Yeah, I think we've touched on a lot of important points. I think that it's not, ultimately, cross-asset vol isn't that strongly correlated, right? And people, I think, usually when people ask, oh wow, like rates vol is really high, why isn't equity vol really high? I mean, look at a bunch of historical data on equity vol and rates vol. They don't really have that much to do with each other. So like, it's actually, if equities are going down slowly on 25 realized vol, implied is going to be high 20s or it's going to be low 30s, right? It's not going to be 50, it's not going to be 60, because if it is, then it's a money printing machine to sell it, right? And to Mandy's point, there's plenty of people in the market. A lot of the aggressive, crazy tail risk selling is gone. Those people didn't live through March of 2020, but there's lots and lots of folks in very big size who are happy to do call overwriting and cash secured put selling and strangle selling and limited loss, volatility selling as equity replacement. And if VIX was 60, the market's not moving that much, those folks are going to be incredibly aggressive and they're going to bring vol down, right? Because we're not experiencing a market crash, we're experiencing kind of a slow, choppy grind down, right? The thing that, and again, it comes back to positioning, where the thing that makes equity markets go down 10 or 12% in a day, that's when Druckenmiller is long 100 billion and turns to his trader and says, get out now, right? That's what makes markets go down 10 or 12%. If fast money doesn't have those big long over leveraged positions and they're not in the market and they're bearish or they're short, it's very difficult to get huge messy moves down. In a funny way, people have alluded to this, but it's sort of the first time that in some sense the markets followed a path that was kind of consensus and kind of delivered about what everybody thought, and versus thinking back through the last 10 years where the consensus was always kind of chasing the price action and always wrong. I think that's the big difference.
Mandy, I see you nodding. Did you want to say anything?
No, I agree. In agreement.
That sounds good. Well, I want to throw this question out to all of the panelists. So as interest rates move higher, as central banks try to fight inflation, what influence does this have on the structured notes business that's seen tremendous growth in recent years? Could you comment on that?
Yeah, I'll jump in this one. So I actually have a background in trading exotics, so this is a space that I am very, very well familiar with. And in my prior role, when I was on this desk, it was during the time where the exotic side, specifically the Phoenix Auto callables and levered buffered notes and barriers, started really taking off in the US. I know last year it surpassed Asia, but during the beginning of 2020, a lot of banks were getting activity for this. And my view to this may be a little bit different than some other people's views, but the issuance of these notes, well, first and foremost, the notes became really popular because people were really focused on getting some type of yield when rates were extremely low, right? Rates are clearly moving up, so the appetite for this is may be changing. I'm curious to see what the numbers will be for the first quarters of this year. But one thing that I have observed is that when these notes get issued, the banks have to hedge the other side of that, right? So your job as a trader on exotics desk, you issue this note, effectively you're long Vega, and then you're trying to offset that. So let's say you have some sort of 2-year note, right? You're going to go out into the listed options market and try to sell vol against that. Now, you would like to stay tenor neutral, but the majority of the time as a trader, it doesn't work that way, right? So what you may say is, okay, I'm going to take a little bit of additional gamma risk. I'm going to sell some 3-month vol. I'm going to sell some 6-month vol. I'm going to spread this across, sell some 1-month vol. And from what I've seen is that the issuance of these notes have led to suppression in the front of the term structure, because I think some traders are thinking, well, yeah, I could sell a little additional more vol here and pick up a little more premium, and next thing you know, I'm just inherently long vol on this as vol doesn't increase in the front of the term structure. And during March of 2020, there were a couple banks that got hosed on the gamma risk of this. So literally exactly that. Front month vols blew out. They lost too much money on the short vol stuff on the front side, and the 2-year notes, things of that sort, didn't pick up to really offset that. So I think that this is something to continuously observe, especially because you have a lot of exchanges that keep putting out more and more and more short-dated listed options. And it's becoming an area that you have to focus on, especially because the market has gotten so much bigger and the reach for alternatives have as well. And we wrote a paper that touches on all these different structural dynamics in the equity market and what has drove the equity market for the last 5 years and what could potentially be some of the hazards that exist out there. Right, so we're not on a perma-bear type of base saying, hey, this is going to crash the equity market, nothing of that sort, right? But I think it's important for people to understand how the structured products area, especially because it's becoming bigger in the US, has an impact on the listed options market.
Great, thank you very much, Chris. Would Bandy, do you have any comments to make on that question?
Sure, I can give some color in terms of kind of what we're seeing on our desk recently in terms of on the back of, structured, products desk hedging and opportunities that has created. So I would say, on the US side, so, these products obviously a bigger impact in Europe and obviously in Asia, but on the US side, traditionally, you really see the impact of these products in Russell volatility, right? And that's because traditionally most auto callables, it's on a worst of major indices, and Russell typically over the past couple of years has been the worst performing index. So what you get is, as obviously Russell sells off, dealers get longer Russell Vega, so they have to sell Russell Vol as Russell sells off. And here I'm talking about longer dated 2-year, 3-year volatility. What's changed recently and that we've been highlighting is that you're seeing now this dynamic more and more in NASDAQ. And that's because NASDAQ is now the worst performing in a lot of baskets, right? So as NASDAQ sells off, longer dated NASDAQ volatility has actually compressed relative to S&P, and that obviously creates really attractive entry points for a lot of RV hedge funds that's looking to own NASDAQ volatility, right? So I would say that that's one theme that we observed over the past couple of weeks is funds looking to buy NASDAQ volatility, in this environment of higher rates and higher inflation and more macro volatility, and obviously the sell-off in tech not abating, and looking for good entry points, and now actually looking at longer dated NASDAQ versus S&P spreads, and owning in different exotic formats, which I won't go into in detail, but I would say that's one area that we've seen definitely a pickup in interest that's come as a result of structured retail products.
Manny, just for the audience, when you say longer dated, are you saying like 2-year? Everyone lives in a different timeline, so I was just curious.
Yeah, 2-year, longer dated, yeah, 2-year.
Establish that. Thank you.
Great.
Well, the one thing I would add is I think if you compare how exotic desks are run today versus even 3 or 4 years ago, in terms of the impact on the market. Historically, I would say you saw a lot of folks taking material basis risk in how they manage their hedge books on XO. In the old days, even selling variance against auto calls, like they blew up in 2015 in the HFCEI in a really spectacular way, and taking a lot of dividend risk, which you saw blow up in Europe in 2020. I think especially after 2020, there was a big risk clampdown across a lot of the biggest exotic houses dealing with structured note issuance. And you've seen, even though those flows have been huge and the issuance has been huge, the long dated left tail hasn't gotten crushed nearly as much, and that's because traders are being forced to actually be long it, right? They're selling Vega, they're selling that down 20% strike 3 years out, but they're having to buy back the 40% strike or the 50% strike. And a lot of the really messy behavior in markets that you used to get when you got that second big leg down in equities past kind of peak Vega in auto call land, I think is likely to be somewhat cleaner. Because you don't have that, in some sense, like reach for yield on the XO desk, trying to get paid a little bit extra in most scenarios. We'll see if I'm right about that, but I think that's the assumptions that we're working under.
Thank you very much.
I think that point too on the structure.
Go ahead.
Just on the structure world, you're seeing a lot more of these products coming to the exchange traded community as well. In the form of defined income type ETFs. You also have, some of these are funds that have defined income, but are trading in listed options as their hedges on the shorter dated all these dynamics also come into play as well. They're usually much more shorter dated in maturity, but there's been a big growth in that whole area. And as well as just in general, the RIA community has had better access to structured notes across the different banks. Used to be we had to be a customer of Bank A in order to trade their structured notes. Now there's ways to get access across the different banks from one platform or from one entity where your assets are housed. So that's been a pretty big dynamic, I think, in the market overall, just in the shorter dated volatility complex.
Could you talk a little bit about spikes?
In what way?
Well, I put up a chart, and can you explain to the audience what they're looking at and sort of how your clients use it?
Thanks, Mitch. Yeah, this is something I mentioned earlier. I think when you had got cut out for a few minutes there, but just really talking about the difference between the spikes and the VIX index and how highly correlated the two of them are. I won't repeat what I said earlier, but just wanted to point that out in this slide. But some of the things I wanted to mention was just some different, if we got a few minutes, just for some potential like trading strategies that people do deploy using VIX and spikes, whether it be options and futures, as well as there's the ETFs that are out there too, and there's a filing that's been approved for 2 ETFs on the track that spikes futures index as well. So, but do I have a minute to just kind of run through a couple trades that we
absolutely do. I've got a few more questions, and then I'm going to turn to audience questions. So go right ahead.
And I'd love to hear if Ben and Chris, if you have any other thoughts. But just real quickly on when people trade, spikes type products, VIX, you're trading the term structure of volatility. So it's very important to know that you're not trading that spot index. You're trading, the different maturities themselves. And just like a Eurodollar strip or the term structure of volatility can move in very many different ways. The back end can come down, the front end can go up, and vice versa. So it's very important to know that as much as they're all correlated, all the maturity months, they may not be correlated on certain days or certain events, certain shocks. So it's really important to know the bucket you're trading in. But in general though, if people when you say hedging using volatility products, it's like, well, what are you hedging against or for? Are you hedging right now with vol's up so much? Maybe you have some gains in realized volatility, or in volatility you want to hedge using a short position in volatility, or otherwise maybe you're nervous about a big drawdown in the markets tomorrow and you think volatility is going to spike. You might want to do some different kind of strategies to hedge to that scenario. So I'll just be another minute here, but some of the things you see people doing is just carrying a long future with a long equity portfolio, and kind of dynamically hedging that part of it. Maybe rules based. It may just be feel, maybe just different target levels. Picking a maturity is always the hardest on these products. The shorter dated is typically more sensitive to moves in the underlying equity market. So you will see typically the vol outperform a little bit more in a down equity market. As we just mentioned, though, that kind of broke down. But in the day-to-day, in the intraday moves, it's typically that that correlation, inverse correlation, is a factor. One of the big trades people like to do for the ultimate end of the world type crash scenario trade is other than just making long calls, would be like 1/3 call spreads, owning the 3 upper strikes, selling one at the money. In this case, if nothing happens, the structure, everything goes out worthless. But in the event there is that catastrophe, you've got that back spread on, you've got outperformance of those extra optionality that you have and own. Call it convexity, as you will. And then just some other things would be on the other side, maybe hedging for the lower vol environment, like they call them the roll down strategies, where people might buy calendar spreads and futures. They might buy put spreads. They might do there's selling calendar put spreads to play that the shorter dated volatility might come in faster than the longer dated volatility. So I'll just leave it at that. But I just I just wanted the one reminder is just that the term structure of volatility can have some unique moves, and something to be aware of when you're trading the product.
Well, thank you, Tom. And we'll make sure that the attendees have your contact information from MyX if they want you to elaborate on any of those things.
Sure.
But we appreciate your sponsorship. I want to turn to all of you again with another question. So for the broader audience, in an inflationary market, what market dynamics should change, and what else would you expect to change? Perhaps we'll start with Chris.
Yeah, I think this is one of those markets where so much variability is going on that it's kind of best to, I mean, maybe this is just my view as a trader, but to just move with flow, because I'm not too sure, you know, if you ask for my outlook in the next 3 months, I'm not too sure. I'm not too sure what economic numbers are going to come out with. I'm not too sure what the Fed is going to do. Really no clue. One of the things that I think will happen, again, from a trading standpoint, I think you will see vol eventually outperform in the equity space if you do get that type of slide down. That's really the only thing that I'm saying, is that if all things stay constant and the equity markets start sliding lower, I think those Delta One type hedges, will do the job to an extent, but I think you'll see people reaching for some sort of upside convexity and vol, and that relationship will begin to outperform. I think we just haven't hit that level as to where anybody is in some sort of a force pain threshold. Because there was a lot of gains in 2021, right? A lot of gains coming from 2020. And I think we have yet to reach that tap out level where people just aggressively say, all right, I want to buy upside convexity. And to Mandy's point, positioning has switched. But I think there is still some people out there that have a bullish view. Psychologically, there's people that say or think in this frame that when equity markets go down 20%, that's kind of it, right? Down 20%, oh, it can't go down 40%, can't go down 50%, can't go down 60%. And the understanding of the probability distribution that way is just not true. So that's really what we're looking at, is consistently trying to monitor that relationship and trying to figure out when we'll be in that area where that relationship will start to outperform. Because in terms of the actual economic implications, I feel like there's just been so much mixed noise from so many different angles, and it's hard. If you're a macro guy, it's definitely hard to take all of this in and kind of wait it out on an equal space.
Thank you, Mandy. You're up next. So again, the same question for you.
Yeah, sure. I can talk about what we've been recommending clients do and what kind of trades we like. So I would say starting at the beginning this year, our favorite trade was looking at sector rotation, sector dispersion as a way to play high inflation, with a view that's obviously going to hit different sectors differently. And that, to the point of very little index volatility, we've seen incredible sector dispersion. We've seen incredible single stock moves this year. So there has been volatility in the market. It's just, happening at the stock and the sector level. So I would say the sector level, now favorite trade coming to this year to play the stagflation theme was going long energy, short US retail. So, playing more commodities supply driven inflation, but with the view that, consumer spending is not going to keep up. That what we had last year was, in the past 2 years, was a fiscal stimulus driven massive demand shock on the back of a supply chain disruption. That's not going to continue going forward. So bearish US retail. And then starting in February with the Russia-Ukraine crisis, also bearish financials and just, cyclical sectors in general. After the euro-dollar curve inverted, with recession risk, rising, that's kind of the call that we've made. More recently, though, we're really starting to look at the energy call more closely, because I think, again, if we're going into a recessionary environment, at the end of the day, energy is still a cyclical sector. If the demand destruction is great enough, I do think there's actually more downside to that sector. So we're at the point that, we're recommending investors start to look at overwriting their energy exposure. It's clearly the sector that has done by far the best year to date. And in macro portfolios, obviously commodities have run up a lot. I do think that is probably, we talk about further pain points for investors. This is where it's going to come from, because I talked about how in all our meetings, everyone's bearish equities, but at the same time, everybody is still highly convicted in the commodity super cycle trade. And I think, the demand destruction, the demand risk, the global growth downside risks are great enough that I do think that's going to be a blind spot. So what does that mean? I think, industrial metals probably see further downside. I think oil, even oil, if you look at oil options market, now starting to price in more downside risk, right? So one of the things that we highlighted recently is skew in oil has flipped. It was, very inverted after Russia, Ukraine, right? Because all the risk was to the upside to oil. Now it's flipped back to being positive, meaning puts over calls, as there's now more downside risk being priced into the commodity space. So I do think that's going to be the next pain point. We're not recommending, clients go outright bearish in energy right now, but just, starting to take profit overright. And then, as economic data comes out, my key view is, inflation may stay elevated in the near term, but I think next year, when we're sitting here, we're not going to be talking about inflation. We're going to be talking about recession. So, all the trades kind of flow from that view.
Thank you, Mandy. We have to have you come back next year, all of you, to cover that discussion, and maybe we'll do it in person.
That would be
Ben,
great.
would you have anything to add to that question, with regards to an inflationary market and if there are any market dynamics that should change?
Sure, and Chris and Mandy did a really good job of covering a ton of it. I mean, I'll just mention a couple of points. I think for the first time in at least 15 years or so, this is actually a macro-driven market where a lot of the underlying risk that's moving markets is coming from rates and currencies and fears about inflation and fears about where interest rates are going, as opposed to from more technical positioning in equities or re-rating in equities. And so certainly I think what that means, obviously we continue to see big cross-asset volatility, not equity market-driven volatility necessarily. Within equity derivative space, I think it means that you see a lot of correlation and dispersion at the sector level and at the factor level, right? Where a lot of what drives essentially the dispersion and correlation trade ends up being, those huge factor rotations where we have energy up a ton but tech down and index relatively flat. And I think you keep seeing a lot of that, and some of the within sector dispersion potentially being a little bit more muted. But yeah, I mean, these guys covered a lot of the right points.
Well, thank you very much to all of you. I have one final question for the panel, and I just always like to throw this in whenever I moderate, but clearly there's something I should have asked you that I didn't. And starting with Chris, what is that? Is there a question that I should have thrown out there, something that you wanted to comment on, anything?
Well, I think I'll take this time to just add one more point. All of us are on this panel because we clearly are talking our book to an extent, right? We're all believer in volatility. Right? We all have this understanding that volatility could be used effectively. So Tom, I think I have that one chart that I seen you flash a couple of times, but I didn't get a chance to really talk on it. But I think this chart, when looking at the S&P performance, is
Yes.
Mitch, can you pull it up?
Oh, is it that one? Is it this one?
No.
It's blue and green lines.
Let's see here.
Yep, there we go.
There you go. Thank you.
Yeah, no, I think this is an important thing for investors that are out there, right? Because they're probably looking at this and they're saying, well, what is really the benefit of volatility? And I think that it really boils down to this. So if you take a look at this chart, it's just the S&P over the last 15 years or so. And what we did here was we just removed, and obviously in hindsight, right, this is a little bit of cherry picking, but we removed 5 of the largest losses coming from the S&P during this time period. And what you see is that the S&P performance doesn't double, it doesn't triple, it actually quadruples, right? And really, I think to everybody on this panel's point is that volatility could be used as a real effective hedge during certain regimes and moments. And this is what it's all about, is being able to sidestep those large losses and compound gains at a higher rate, right? So when you think about, well, what's the point in me constructing a portfolio with volatility? Well, the end is exactly this, because it allows you to sidestep those large losses because of the asymmetry of it, the return profile of it being so convex, and really create a holistic portfolio. So that's really the real reason why I think the majority of us are advocates for vol. because of the power that it has. Because on average, right, volatility will be a negative decaying type of asset class. However, during these brief moments, it adds to the overall portfolio and it allows you to have that net compounding return that is really powerful over the course of a full market cycle.
Mitch, who do you want to go next? Mandy, go for it.
Go for it. Yeah, excuse me.
Oh,
What
sure.
didn't we talk about that we should have?
I don't know how much time we have. You know, I would say again, like I've been on the road a lot, and I would say, you know, I highlighted the commodities trade as potentially blind spots. The other area that, you know, we didn't get to talk about, but I think is going to have a massive impact when we talk about volatility and inflation in particular is China. And that's another area that we've seen, I would say, a healthy two-way dialogue, let's just put it this way, in meetings where I would say the consensus, the buy-side view is that China cannot continue zero COVID for long, that it's going to reopen, and that is, you know, the core of a lot of people's, you know, upside view in terms of markets going to year end. And my view there is that, you know, China's not going to abandon zero COVID anytime soon, certainly not before the October political, you know, the big political handover, well, quote unquote handover meeting, and that ultimately, you know, the risk of China, it's not inflationary, it's deflationary, and that's going to be the next, I guess, you know, the source of downside risk to markets and the next, you know, tail risk. But I won't get into too much detail, but I would say that is, you know, in terms of what could drive changes in the inflation regime, what could drive changes in the volatility regime, that is another risk that, you know, that I'm looking at very closely.
Thank you very much. Go ahead, Tom.
We'll get you back. Okay. No, well, Ben, go ahead.
Sure. So I think that we touched on this very briefly in the beginning, but a very different direction that a lot of asset owners went to manage volatility in their perception the last few years has been moving assets into private equity, right? And I think, you know, we all smile a little bit when we label that as managing volatility because, of course, it's not managing real risk or volatility, right? It's just smoothing the return stream. Because private assets aren't marked, they're just held on your books, maybe at wherever the last valuation round was, potentially at very different marks at different firms. And I think you're just now starting to see that cascade through, right? Where particularly in late stage growth tech, a lot of the public market comps for those Series F, you know, Deca unicorns are down 80%, they're down 90%. And the marks in the private funds are still flat. And I think that's going to create a pretty good liquidity crunch among a lot of institutional asset owners that really got over their skis moving assets to privates, because you start to get capital calls on a lot of new funds that you've been forced to commit to in order to maintain access to the big firms. Meanwhile, you haven't gotten distributions on funds that are 15 years aged at this point, and you know the liquidity cushion that you have is getting really, really tight. So I think we're kind of starting to see the end game in viewing private assets as a risk reducer and a volatility mitigator. I think that's very much the wrong way to think about private assets. You know, venture can obviously be a great asset class, but you need to think about that at the very aggressive end of the risk spectrum. It's definitely not a risk reducing component of your portfolio.
Thank you very much, Ben. And Tom, did you have any final remarks that you wanted to make?
Yeah, I mean, I would just add, you know, we're in a very unique time period, as we all know. It's with this inflationary environment, you know, since the early 90s, the highest levels we've seen on the CPI have been around the 4% level, and now we're, you know, kind of out of that regime. So it's, you know, it's to be seen how the volatility regime, you know, continues forward. I would imagine it would stay elevated, you know, as long as there's all this, you know, rate volatility going through the markets. But one thing I wanted to add too is just, you know, thank you very much to the panelists, and thank you, Mitch, for hosting, and the Hedge Fund Association. I think you guys, you know, everything was great, and I really enjoyed, you know, spending time with everybody.
Wonderful. And again, I'd like to echo that. Go ahead, Mandy. You were saying something?
No, just echoing that point. Thank you, guys. Yeah, it's been a pleasure.
It's a pleasure, and you guys were outstanding. I apologize for my technical hiccups. Something weird happens in Miami every afternoon in my internet. But we'll resolve it before we do this in person. And just for the attendees, where you have a recording of this, we're going to circulate that Shortly, you'll get a copy of the PowerPoints as well. Obviously, there'll be a way for you to reach our sponsor, MyAx. And have a great afternoon, everyone. And again, thank you very much.
Take care,
Thank you
guys.
so much. It was a
Thank you very
pleasure.
much.
Take care.